Hello, everyone, and welcome back to another edition of the Wisconsin Bankers Association Compliance Corner. This is the July 2025 edition, and Scott and I are excited to once again join with you as we walk through several compliance-related items that have been recently released by both state and federal agencies. Our format this month is similar to our previous editions in that we will have several items we will cover at a high level as is earmarked on this PowerPoint presentation, and we have included a companion link for each of these items for you in the event that you need to go back and reference each item and further review the details. So with that, we're going to launch into the video series here, and first up, we want to make sure that you are aware of a newly created resource by Wisconsin's Department of Justice and the WBA Green Bay regarding how we can safeguard our seniors from financial abuse. Scott's going to walk us through a number of different resources embedded within that free online platform. It's a great item, and want to make sure that our membership is aware of that tool. We also have some happy news to share regarding the postponement of Section 1071 final rule. Scott will cover that one as well. Also, this video, we will be talking about a recent order by FinCEN that has provided an alternative for how banks are able to obtain TIN or TIN information underneath the 2003 CIP rule. We have a rescission of some of the back office servicing requirements that lenders need do underneath FHA programs, in particular for the single family mortgage insurance program. We also want to make sure you're aware that OCC has released their spring 2025 risk perspective report, that the Fed has followed other agencies in revising their examination scope to reflect the removal of reputation risk from those considerations. And also, Scott will be talking about requests of information from our federal agencies regarding payment fraud. So with that, let's get into the nuts and bolts. Scott?
All right. Thanks, Heather. Yeah, so let's start with our first item here. And we have a state item. As Heather mentioned, the Wisconsin Department of Justice is working hard on resources to help combat elder financial abuse, right? And so this goes to outreach, this goes to partnering with various agencies and organizations, to the creation of resources and the funding of programs. And UW Green Bay has a Wisconsin Elder Justice Coalition. And this coalition collaborates with DOJ along with other state agencies to promote awareness and create resources for elder justice in Wisconsin. And recently, one of the creations that this coalition came up with is creation of a free training guide for financial institutions. And this guide, so the coalition and UW Green Bay has been working on a lot of different resources and topics within this area. And they had actually created some resources that were designed for financial advisors and financial planners, right? And kind of looking at the broader scope of where elder financial abuse crops up and where it can be targeted to help stop it. So as part of that, they created this one that's now designed specifically, explicitly for financial institutions. And it's designed to help financial institutions and those that are using it that work for financial institutions recognize and respond to financial abuse, obviously that specific to targeting elder customers and those that might come up as scenarios later in life. And so what's great about this is you can use it however you want. Again, it's free and it can be done at your own pace. So it can be picked up, put down, come back to it later. And it covers a variety of different forms of financial abuse. It talks about risk factors, warning signs, and appropriate reporting channels. So you can be aware of, all right, we recognize it. Where do we go? What do we do with it now? This is also something that the UW and the coalition consulted with DFI on. So DFI is aware of this. DFI gave permission for creation of this specifically for banks and credit unions. So make sure to take advantage of this tool, either for yourself or maybe for training purposes, to something to run through to help develop training, or something to direct new staff to help them understand how to protect your senior customers. And again, just want to mention it's completely free, so take a look at that in the link in the description below. As Heather had mentioned, on this next item, we have some happy news for you in the postponement of 1071. And so as we're here now reflecting on 1071 and the path that's brought us here, think back. This rule was first proposed in 2021, and now we're here. And where here is exactly is that on June 18th, CFPB did publish an interim final rule that extends the mandatory compliance dates for all covered lenders for about 1 year. I say about 1 year because what they did was they set the dates for the first of the month, which is something that the industry had advocated for. That's something that ABA had been bringing up as well in the ongoing court case. But we had commented as well when CFPB previously extended the compliance dates, and there was an opportunity for a comment there. So that's something that CFPB did end up adopting. But everything is kind of now led up to this. The ongoing litigation surrounding 1071 has led to this. And around this time a year ago, CFPB had extended the compliance dates. And then earlier this year, I think back in February, the court granted a stay, which further brought those dates out. Then when CFPB was instructed to initiate new rulemaking with 1071, that ultimately is what led to this postponement. And so now we're at the state where we have this postponement. You can see CFPB created this helpful chart that we've got for you on the slide. You'll find that in the interim final rule as well. But ultimately, at the end of the day now, what we're waiting for is this new rulemaking while we're in this postponement period. And so we do anticipate that a new proposal will be forthcoming. It might replace or change the current rule, so still stay tuned on that 1071 front. With that, I'll hand it back off to Heather to go through some other items.
Thanks, Scott. And as mentioned at the outset of the video, one of the items we wanted to cover with you is that FinCEN has issued an order recently, and that is asterisked here on this slide because this is one of the items that you will find in the companion link below. So FinCEN issued an order that was in response to comments that they had received from the industry as a result of an information request. And it relates to how we're able to collect CIP information from our new customers. And if you think back, we've been working with CIP rules since 2003. And through those requirements, we need to collect certain information from our new customer when we're establishing a new account being something as defined by CIP. And we need to form a reasonable belief of who we believe this new customer is. And we need to retain that information in accordance to the record retention rules underneath the BSA rules. And through the information requests, the industry and state bank associations and others have shared with FinCEN that through that course of time since 2003, there have been technology advances that allow for third parties to collect the information that is otherwise required to be collected underneath the CIP rules, do so in a safe way where the materials are collected and safeguarded from any wrongdoers or any malicious attacks of information. And it's retained for the time period that needs to be retained underneath the rules. And it's thorough, just as much so as if the banker had collected that at their desk or through the loan closing when they're looking to establish the account. And so having received that information, FinCEN also agreed that, yes, there seems to be times now where there are third parties who are able to collect the information that is required and meets all the other requirements of the BSA rules. And so through the order, you will see that now banks are given the opportunity that as an alternative to collecting information directly from the customer, that a bank is able to collect CIP information from a third party so long as certain conditions are met. And we have those conditions listed for you on this slide, where again, the timing is important, that the CIP TIN information is obtained prior to opening up the account, that you are collecting the information and you are using this third party in alignment with your own assessment of the relevant risks for using this third party, and that having collected the information is able to be verified, and that the bank is still able to have a reasonable belief of who that identity is or what that identity is of that new customer. So making sure that those conditions are met, this is going to be something that you would need to revise your CIP policy in general for. You'd want to make sure that you've demonstrated what your risk assessment is, so that if you adopt this new process, you're able to explain to your examiner teams the thoroughness that you went through to review that the requirements are met, that you're able to form your reasonable basis, that you have the record retention. All of those components would be something that you want to show your work, so to speak, with your examiners when they're looking at this new process, if in fact it's something that has been adopted. So something new meant to help with some of the regulatory burden. I think it's great that the federal agencies are thinking more broadly on this particular topic. It's also great that this option came out as a response to all of us bankers contacting FinCEN and telling them what kind of information can be updated from an old regulation and the new technology that should be used as we advance forward since 2003. So good news there. On the next slide, we wanted to make sure that for those of you that work with FHA, in particular the single family mortgage insurance program, that recently there were several rescissions made to some of the back office, as I mentioned before, steps. And the hope is to allow for some underwriting processes to be loosened a little bit in a safe way, but operationally then less burdensome. So one of those examples is being an update to the appraisal protocol, where there are some steps that were more administrative in nature that are no longer needing to be completed, and that doing so is not at all jeopardizing the integrity of the appraisal or the valuation that has been completed. Another example is that now underwriters may be a part-time position versus a full-time position. So those are the types of changes that have been made. Again, not at all affecting the integrity of the program or have any detrimental effect, but primarily that of an operational component. And I won't read through all of those, but certainly we've included the more thorough background information piece of those changes, and we've highlighted a few things on this slide here. Scott, you want to take us through the next topic?
Yeah, so our last item here, actually a few different state agency items here, just to cover really quick and make you aware of. Again, we do have more information in the link in the description below. So take a look. Just kind of want to give you a concept of this, and just starting with OCC's Spring 2025 Semiannual Risk Perspective. Again, lots of great information in here to check out in more detail, but to give you a high-level summary of what you can expect and maybe what you want to go and take a peek at in there. It does cover some trends in key risks. Those have been categorized in areas of credit, market, operational, and compliance. Now, some themes just overall in how the OCC is presenting this include a discussion on the strength of the federal banking system, discussion on some areas of increased risk in relation to commercial credit, but then the stability in areas such as retail credit and market and liquidity risk. Also a discussion regarding factors leading to increased operational and, of course, some compliance risk factors to take a look at as well. So again, pull up that perspective, take a look through. It does cover trends in those areas among some others as well. And then, as Heather had mentioned, and as we had kind of anticipated as well, I think in our last conversation, we had seen that the agencies had taken this approach. We're kind of expecting that the Fed would follow suit here. And FRB has announced that it will be removing reputation and reputational risk from all of its supervisory materials. So all mention of reputation, all mention of reputational risk, that includes references in exam manuals, and FRB clarifying that it will no longer be part of its examination or supervision of banks. That said, FRB said that they're going to look at potentially replacing those areas instead with more specific areas of risk. So, for example, looking at maybe scenarios where there is actual explicit financial risk to the financial institution, but no longer referencing that within the scope of reputation. Then there's also an interagency request for information here, and this is actually on potential actions to address payments fraud. Largely payments fraud meaning what you think it's going to mean. Have a definition for you on the slide, and I'll mention that in a moment. But what the agencies are looking for here are comments to identify ways that they can help consumers, businesses, and banks, right? So all the parties involved within the sphere here to mitigate check, ACH, wire, and other payments fraud. So then payments fraud, right? That scope generally referring to any illegal means. So intentional deception, misrepresentation, or manipulation to make or receive payments. And the agencies, this is a good inclusion, right? Because a lot of times when we think fraud, we're thinking, well, does that include a scam, right? And the agencies do specifically say, yes, we are including scams here as a subset of fraud, as I think we all do, right? When we see fraud and we think of fraud, scams just go hand in hand with that, right? So there are 5 potential areas of improvement and collaboration that comments are requested here. And I'll say too, it's not a long RFI. I would take a look at it and just look at those areas where they're specifically asking for comment. But this is obviously an important topic for the industry right now. So encourage everyone listening to this right now, pull it up. Even if you don't have time after this, leave it on your monitor as a reminder to take a look at later. If you have any comments or you want to discuss it, you want to discuss fraud or what is on your mind, please give us a call. Please reach out. Please shoot us an email. We want to hear from you. We'll be commenting on this. So what is on your mind? Where are areas that we can give comment to the agencies? Again, they do give 5 potential areas that they're specifically looking, but really anything in this realm, right? In this broader realm of payments frauds. So let us know what your thoughts are. We'll be looking to develop comments on that. They are due in September. All right, so with that, we are going to wrap up, but don't leave just yet because we have a reminder of all the great resources that are available to you. On the WBA website, we, of course, have compliance tools and resources. Don't forget on the webpage where you can find old compliance journal articles, current compliance journal articles, the best practices library. If you're looking for guides, we have a really comprehensive guide on banking minors. We have a really comprehensive flood guide, really comprehensive transfer by affidavit guide. And of course, if you have questions, anything comes up in that guide, make sure to give us a call on the compliance hotline or send us an email. And of course, the other ways that you can get involved. So take a look into that link to join a WBA committee or section and consider becoming an advocate for the banking industry as well through the Advocacy Officer program. So with that, we are going to wrap up this month. Thank you for joining us. We will see you next time.